If you own silver, stop what you are doing. Because three separate forces just converged on the same 48-hour window, and each one of them alone would be enough to move silver violently in either direction. Together, in the same weekend, pointing at the same Monday open, the setup is unlike anything we have seen in this entire cycle. I am going to walk you through each force individually so you understand the mechanics. Then I am going to show you exactly what the convergence of all three means for what happens when the Asian session opens Sunday night. Not theory, not prediction, mechanics and data. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1. Force number 1, the jobs disaster that just hit this morning. Non-farm payrolls in the United States declined by 92,000 in February. This reading followed the 126,000 increase recorded in January and missed the market expectation for an increase of 59,000 by a wide margin. J.P. Morgan. Let me put that number in context because the headline alone does not capture how bad this actually was. The market was expecting 59,000 jobs added. The actual result was minus 92,000. The unemployment rate came in at 4.4% against expectations of 4.3%. Fortune, that is a miss of 151,000 jobs. Not 10,000, not 20,000. 151,000 jobs on the wrong side of zero in a single month. But the headline miss is not even the most important number in this report. The revision is: the change in total non-farm payroll employment for December was revised down by 65,000 from positive 48,000 to negative 17,000. The change for January was revised down by 4,000 from 130,000 to 126,000. With these revisions, employment in December and January combined is 69,000 lower than previously reported. One India, read that again. December was not a 48,000 job gain. December was a 17,000 job loss. The Bureau of Labor Statistics just told you that the economy lost jobs in December and lost 92,000 jobs in February. February marked the third time in the past 5 months that payrolls declined. The Sunday Guardian. This is not a slowdown. This is not a soft landing. This is the labor market cracking in real time while the Federal Reserve is sitting on its hands at 3.5 to 3.75%. Employment in healthcare decreased by 28,000 in February, reflecting strike activity. Offices of physicians lost 37,000 jobs. Employment in information fell 11,000. Federal government lost 10,000. Transportation and warehousing lost 11,000. Manufacturing lost 12,000. One India. That is not one sector having a bad month. That is a broad-based multi-sector contraction happening simultaneously. And this is the data that the Federal Reserve walks into its March 18th meeting carrying. What does this mean for silver? The U.S. job market weakening appreciably in February has put back in play the chance of Federal Reserve rate cuts in the first half of 2026. Fortune, the dollar fell immediately after the print. And when the dollar falls, silver's mechanical headwind becomes a tailwind. Markets are now pricing in multiple 2026 rate cuts. Political tension over Fed independence adds a risk premium. The combination is supporting precious metals across the board. Yahoo Finance. Force number 1 is active. The labor market just broke. The rate cut story that was declared dead 2 days ago just came back to life. Section 2. Force number 2. The CME flush that happened yesterday. I covered this in detail in yesterday's video, but I need to put it in context alongside today's NFP because the sequencing matters enormously. Yesterday, Thursday, March 5th, the CME raised silver maintenance margins by 36% overnight. Silver, which was trading near $91 at the start of the week, cascaded to $82 to $83 in the London session as leveraged traders received margin calls and were forced to liquidate positions they did not want to sell. Let me be precise about what that flush did to the market structure. When a leveraged trader gets margin called and sells, they are not selling because their thesis changed. They are selling because a clearinghouse sent them a collateral notice. The position transfers to whoever is on the other side of that trade, and the people on the other side of forced liquidations at lower prices are typically better capitalized and longer duration than the trader who just got margin called. The CME margin flush yesterday was violent. It was painful for anyone who was leveraged long, and it did something structurally important. It cleaned the weak hands out of the market, going into one of the most data-heavy, geopolitically volatile weekends of the entire year. Here's the historical pattern you need to understand. In this silver cycle, every major margin hike flush has been followed by a recovery once the forced selling exhausted itself. The February margin hike from 15 to 18% caused silver to crash from $120 toward the 70s. Silver then stabilized, consolidated, and recovered toward $91 before this week's events. The flush creates the setup. The fundamental story determines what happens after the flush is complete. Yesterday's 36% margin hike flush removed the leverage speculation from the market. What is left after the flush is physical buyers, unleveraged long-term holders, and institutional participants who were not using leverage. That is a cleaner, more stable market structure going into a weekend where two additional massive forces are about to land. The CME flush is force number 2. It is complete. The question is what fills the vacuum it created. Section 3. Force number 3. The Strait of Hormuz and what it means for Monday. This is the force that most silver investors are underestimating because they are looking at the price chart from Monday when silver spiked to $96 and then gave it all back by Tuesday. They see a failed breakout and conclude the Iran war is already priced in. That conclusion is wrong. And the reason it is wrong is in the structure of the crisis itself. The Strait of Hormuz has experienced ongoing geopolitical and economic disruption since February 28, 2026, following joint military strikes by the United States and Israel on Iran, which included the killing of Iran's supreme leader Ali Khamenei. Iran launched retaliatory missile and drone attacks on Israeli territory and U.S. military bases in Gulf states, while its Islamic Revolutionary Guard Corps issued warnings prohibiting vessel passage through the strait, leading to an effective halt in shipping traffic. FXS Street. Tanker traffic dropped first by approximately 70% and over 150 ships anchored outside the strait to avoid risks. Soon traffic went to near zero. Protection and indemnity insurance was removed from March 5th, making the economic risk too high for ship owners to use the strait. FX Street. That last sentence. Read it carefully. Insurance was removed from March 5th. Yesterday. The same day the CME raised silver margins, 36%. The strait is not just politically closed, it is economically closed. No ship owner can get insurance to transit it. That is a structural closure, not a temporary disruption. The Strait of Hormuz handles 25% of the world's maritime oil trade and 20% of liquefied natural gas shipments. About 33% of the world's fertilizers, including sulfur and ammonia, travel through the strait. It is also a key route for aluminum and sugar. FX Empire. A full or near full closure lasting a month or more would require demand destruction at levels that could push crude well into triple digits and European natural gas prices toward or above the crisis levels seen in 2022. FX Empire, the Iran war is now in day 6. The strait has been at near zero traffic for 4 days. This is not Monday's spike and Tuesday's reversal. This is a structural energy supply disruption that is getting longer, not shorter. Goldman Sachs estimates an $18 per barrel risk premium already embedded in crude oil prices, corresponding to a 1-month full halt in Strait of Hormuz flows. If oil disruptions persist, Goldman's analysis suggests 15 to 25% upside for gold based on historical correlations from the 2022 Russia-Ukraine war, FXS Street. And silver, which correlates with gold on the safe haven side and with industrial commodities on the demand side, is sitting in the middle of this energy shock with a specific additional vulnerability. Approximately 40 to 50% of China's crude oil imports and about 30% of its LNG imports pass through the Strait of Hormuz. FX Empire China is the largest consumer of silver for industrial applications. An energy shock that hits Chinese manufacturing hits silver industrial demand directly. That is the two-sided nature of this crisis for silver. Safe haven bid pulls it up, industrial demand recession fear pulls it down. Silver is caught in the middle of both forces simultaneously. That is why it spiked to $96 Monday and crashed back to $83 by Tuesday. The market cannot decide which force wins, and that indecision is what creates the setup going into this weekend. Section 4. Why the convergence this weekend is different from anything we have seen. Here is the specific reason that this weekend matters more than any other weekend in this silver cycle. 3 forces: NFP job loss of 92,000, CME margin flush that cleaned out leveraged longs, Iran war with Hormuz near zero traffic and insurance removed. All 3 landed within a 48-hour window, Thursday and Friday, into a weekend where markets are closed and no paper price discovery can occur. When markets close Friday afternoon, silver is sitting somewhere between $82 and $85. That price was set by a combination of forced liquidations from the margin hike and dollar weakness from the NFP disaster. It is not a clean fundamental price. It is a technically distorted price created by mechanical forces. Over the weekend, 2 things happen that paper markets cannot process in real time. First, the Iran war continues without any price adjustment mechanism. If there is escalation, ceasefire, naval confrontation, or diplomatic movement, none of it gets priced until the Asian session opens Sunday night. Second, physical silver buyers around the world who understand the supply deficit, the COMEX vault drain, the China export restrictions, and the NFP implications can accumulate physical metal at prices that the paper market is distorting downward. Silver exploded to $96.40 briefly when the Iran war opened on Monday and then crashed as much as 7% intraday to the high 80s before recovering. Silver is half investment metal, half industrial. War fears boost the investment side. Oil shocks and stock sell-offs raise recession worries which hurt industrial demand. That is why silver swings harder than gold. FX Empire. The gold-silver ratio right now is at approximately 64-1 based on current prices. Gold is holding significantly better than silver through this volatility. When the gold-silver ratio is this elevated, it historically means silver is undervalued relative to gold and compresses when safe haven demand accelerates. A ratio compression from 64 back toward 57, which is where it was when the Iran war first broke, would require silver to outperform gold by approximately 11% from current levels. The weekend setup is the cleanest compression opportunity of the entire cycle. Margin flush complete. NFP confirming rate cuts are back on the table. Iran war with Hormuz near zero, creating persistent energy inflation pressure. All three forces have resolved their immediate volatility. What is left is the structural picture that emerges Monday morning when Asian buyers look at silver in the $82 to $85 range and compare it to the fundamentals. Section 5. The bear case. What sends silver lower Monday? I always give you both sides. The honest analysis requires it. The bear case for Monday's open is not complicated. Iran and the United States reach a ceasefire over the weekend, or credible diplomatic signals emerge through back channels. The Hormuz situation partially resolves. Safe haven demand evaporates. Dollar rebounds on reduced geopolitical risk premium. Silver, which was already under technical pressure from the margin hike, loses both its safe haven bid and its dollar tailwind from the weak NFP simultaneously. In this scenario, the weak NFP actually becomes a negative for silver because a deteriorating economy reduces industrial demand expectations. Solar panel installations get deferred, EV manufacturing slows, the 200 million ounce annual industrial demand picture gets revised down alongside economic growth forecasts. Quantum Strategies' David Roche framed the market impact in terms of duration. If the conflict is short and contained, the risk-off move and oil spike could be brief. If it turns into a longer 3 to 5 week regime change endeavor, markets would react rather badly as investors price in a wider conflict and longer oil disruption. FX Street A contained short conflict that resolves over the weekend is the maximum bearish scenario for Monday's silver open. Silver tests $78 to $80 and potentially lower if the structural support fails. The bear case requires the geopolitical situation to resolve faster than anyone currently expects. As of right now, the strait has near zero traffic with commercial insurance removed, over 150 ships are anchored outside awaiting clearance, and no ceasefire framework has been publicly announced. FX Street. The bear case is possible. It is not the base case as of Friday afternoon. Section 6. The 3 scenarios for Monday's open. I always give you multiple scenarios rather than a single prediction because anyone giving you certainty about what happens at a Sunday night Asian Open is not being honest with you. Here are the 3 most likely outcomes in order of probability based on available data. Scenario 1. Iran war continues without ceasefire. Hormuz remains closed. Dollar stays soft on NFP weakness. Silver opens Monday in Asia between $85 and $88. Safe haven bid from Hormuz plus rate cut repricing from NFP combined to absorb the margin flush selling. This is the scenario where Thursday's $83 low looks in hindsight like the flush bottom before the next leg. Probability, most likely given current facts on the ground. Scenario 2. Diplomatic signals emerge over the weekend, but no formal ceasefire. Partial resolution of Hormuz uncertainty. Silver chops in a range between $82 and $86. The NFP rate cut bid provides a floor. The reduced war premium caps the upside. Markets wait for the March 18th FOMC meeting as the next major catalyst. Probability, possible. Requires visible diplomatic movement that has not yet materialized. Scenario 3. Ceasefire announced or credible de-escalation over the weekend. Safe haven premium collapses. Dollar rebounds. Silver opens Monday below $80, tests $78, and potentially $75. The NFP weakness provides a floor, but cannot offset a full geopolitical premium collapse. This is the maximum pain scenario for silver bulls. Probability, least likely given current straight insurance removal and military positioning, but not impossible. Section 7. The physical reality that paper markets are ignoring. I want to step back from the weekend price action narrative for a moment because there is a structural fact that none of the scenarios above change. The COMEX registered silver inventory has dropped 47% since October 2025, from 167 million ounces to approximately 85 to 88 million ounces. That drain did not reverse because the CME raised margins. It did not reverse because silver crashed from $121 to $82. It continued regardless of paper price. COMEX registered inventories have plummeted over 70% since 2020. Industrial demand keeps accelerating. Solar panels, EVs, and AI hardware are consuming record amounts of silver. Mine production grows at just 1 to 2% annually. Intellectia.ai. The supply deficit is in its 5th consecutive year. That structural reality exists independent of NFP prints, margin hikes, and weekend ceasefire rumors. What the current convergence of forces is doing is creating short-term price dislocations on top of a structural story that has not changed. Gold has rewritten the rulebook on what a precious metals rally looks like, setting dozens of new all-time highs in 2025 alone. The forces behind that climb are not going anywhere. Central banks continue to build their gold reserves, fueling relentless institutional demand, even as prices shattered one ceiling after another. A softening U.S. dollar, rising expectations for Federal Reserve rate cuts, and persistent geopolitical risk have all reinforced gold's appeal. Bullion vault. Everything that drove gold to those levels applies to silver with an additional industrial demand multiplier. The paper price today reflects the mechanical consequences of margin hikes and geopolitical premium swings. The physical market is operating on a completely different track. Section 8. What to watch this weekend. All free, all public, I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on a paid service, that is a scam. You find me here on YouTube and on X. Data drops on X when it breaks. Here is your watch list through Sunday night. Everything is free. Iran war developments. Follow Reuters, AP, and Al Jazeera for any ceasefire framework, naval confrontation, or diplomatic movement. The single most important variable for Monday's Silver Open is whether Hormuz remains at near zero traffic or shows signs of reopening. Wikipedia's 2026 Strait of Hormuz crisis page is being updated in real time and provides a clean chronological record of developments. Link in the description. COMEX registered silver inventory, updated daily by CME Group. If the vault continues draining below 85 million ounces through this week's report, the physical stress story remains fully intact regardless of paper price. Link in the description. CME FedWatch tool. Watch how July rate cut odds move through Friday and into the weekend as the market digests the minus 92,000 NFP print. If July odds climb above 70% by Sunday night, the dollar weakness trade that benefits silver is strengthening going into Monday's open. Link in description. Dollar index DXY. Watch the 98 to 98.50 zone. If DXY holds below 98.50 through Friday's close and the Asian session opening, dollar weakness is sustaining and silver has its macro tailwind intact for Monday. Silver spot technical levels. 80.50 is your structural floor. Above it, the margin flush is complete and the fundamental bid is intact. Below it, on sustained volume, the bear case is gaining technical confirmation. On the upside, $86 is the first resistance. Breaking $86 on volume in Sunday night's Asian session is the signal that the convergence is resolving bullishly. CME delivery reports published each afternoon. Today's report shows whether the margin hike actually reduced standing delivery demand or whether physical buyers are still pressing their claims through the mechanical paper volatility. Section 9. The honest conclusion. Here is the full picture as of Friday, March 6, 2026. U.S. economy shed 92,000 jobs in February, the most in 4 months. Healthcare down 28,000. Manufacturing down 12,000. Transportation down 11,000. Federal government down 10,000. December revised from positive 48,000 to negative 17,000. 3 job losses in the past 5 months. 1 India unemployment rate at 4.4%. Missed expectations of 4.3%. Federal Reserve rate cuts for the first half of 2026 back in play. Fortune CME raised silver maintenance margins 36% on Thursday, March the 5th. Silver forced from $91 area to $82 to $83 range. Leveraged longs flushed. Market structure cleaned heading into the weekend. Strait of Hormuz at near zero traffic since March 2nd. Over 150 ships anchored outside. Protection and indemnity insurance removed as of March 5th. Commercial transit economically impossible without insurance. FX Street. A full closure lasting a month or more could push crude into triple digits and European natural gas toward 2022 crisis levels. FX Empire. 3 forces, all ending in 48 hours, all pointing at the same Monday open. NFP minus 92,000 confirms rate cuts are coming. Dollar weakens. Silver's macro headwind flips to tailwind. CME flush complete. Leveraged weak hands removed. Physical buyers and institutional unleveraged longs hold the remaining position. Iran War Day 6. Hormuz economically closed. No ceasefire framework publicly announced. Physical silver supply chains already disrupted through Dubai and the broader Middle East corridor. COMEX vault at 47% below October 2025 levels. Physical supply deficit in year 5. China export licensing still active. Structural story unchanged by any of this week's paper price action. 3 scenarios for Monday. Iran war continues and dollar stays soft. Silver recovers toward $86 to $88 and potentially tests $90 resistance. Partial diplomatic movement. Silver chops an $82 to $86 range awaiting March 18th FOMC. Ceasefire announced. Silver tests $78 to $80 floor and potentially lower. The most important thing I can tell you going into this weekend is this. 3 things happened this week that retail investors are treating as separate events. They are not separate. They are connected connected forces hitting the same market structure at the same time. The CME flush removed the leveraged speculation. The NFP disaster confirmed the macro is deteriorating faster than the Fed acknowledged. The Iran war with Hormuz closed is creating persistent energy inflation that traps the Fed between two impossible choices: a Fed that is trapped, a vault that is draining, a physical supply deficit in year 5, and a paper market that just flushed its weakest holders out the door. You do not need me to tell you what that convergence historically produces. Pull the December 2025 data. A flush was followed by a recovery that ran from 50 thrice to $121 in roughly 60 days. The conditions that created that run have not disappeared. They have intensified. Watch the Hormuz developments this weekend. Pull the CME delivery report published this afternoon. Check the registered inventory Monday morning. The data will tell you everything. Your job is to actually look at it. Invest with logic, not hype. Protect your capital. When three forces converge in 48 hours, the noise gets loud. The signal is in the data, not the price. Drop weekend watch in the comments if you are monitoring the Iran situation through Sunday night and plan to be watching the Asian Open Monday morning.